Hi guys, thanks for tuning in to another episode of Nuggets News. Well, today I want to make a video to explain everything that's going on around us in the global economy and the monetary system itself. I want this video to be the gold standard that you can share with all your friends and family to understand what is going on if they're not really savvy in terms of investing and wealth management. So, central banks, governments, banks themselves, even economists are now really starting to question the monetary system ever since we went off that gold standard and we started fractional reserve banking and fiat money as we call it now. And central banks had the job of steering the economy. They told us to trust them and they would stimulate the economy when it needed by lowering interest rates and having money more freely available, and then raise interest rates if things got too overheated to prevent bubbles and whatnot. The idea was to smooth out the business cycle, but what we've actually seen that many people would agree with is bigger booms and bust. So we've had the dot-com bubble, the global financial crisis, and now we seem to be heading into uncertain times again when they don't have a lot of the policies available to use that they would have used in the past. So after the global financial crisis in 2008, they tried QE for the first time, quantitative easing, or creating new money, printing money as some people call it, to give out to the banks, to give them more liquidity and reserves. And the idea is that they lend this out to businesses and give out loans and the economy starts growing nicely again. Trickle-down economics is the theory behind this, where if the banks lend out to businesses, then they'll employ more people and it finds its way into the real economy. But central banks' mandates before that had always been about maintaining employment and maintaining inflation, but this was another way of going about it to get the same result. But what we've really seen is pretty weak wage growth, and the rich have got a lot richer. Now they're turning to negative interest rates in a lot of countries around the world, which is crazy to even think that they exist. And the idea is that people will go out and spend their money, because if you've got a negative interest rate on your savings account that penalizes you, you're going to go out and spend, and that should get the economy going. But the opposite is starting to happen. So the average retiree, for example, that's really dependent on those interest rates and dividends, they're no longer getting that yield and that income. So people are actually battening down the hatches and spending less. So it's having the opposite effect as well as affecting the banks, and I'll get to that later on as well. So what we've actually seen is asset inflation. You'll see the stock market's near record highs. House prices have gone up tremendously. Bonds and a lot of other assets, where the rich and the wealthy that got all this money sort of put money, it flowed into these other assets. So they used it to do things like stock buybacks rather than investing in the future of their own company or expansion and employing more people. So it has really led to this inequality, the haves and the have-nots, and we see that in wage gaps these days and lack of wage growth for the average employee. It also allowed these companies, governments and households to take on tremendous amounts of debt. We see household debt, government debt, and business debt near record highs. And we have these, what they call zombie companies now, that are just borrowing money to keep the lights on, and they can never pay down this debt. Some of them are struggling to pay the interest on their debt, even with interest rates at record lows. So rather than smoothing out the business cycle, what central banks have done have kept bad businesses alive and encouraged bad investment or risky investment. And people have just flooded into all these risky assets. And a lot of people, fund managers that are value investors, have found this really frustrating, because businesses that shouldn't be worth much are worth a fortune as all this money has just piled into it. So we've got these record low yields around the world, interest rates and the yields on bonds, and that's pushed down the yields on even the junk bonds and the bad businesses that are issuing this debt. But yet people can't get enough of it, because if everywhere else is paying negative interest rates or low interest rates on government bonds, people are now desperate for those 5% bonds, even though they're junk and the business might even go broke. So it's really just distorted the way that the whole economy and investing should work. And I think many people would agree that it's just led to bubbles in a lot of asset classes. So what this has become known as is the Cantillon effect, where when more money is created, who gets to use it first? Well, central banks, and then banks, and then business owners, and they get the benefits of that new increase in the money supply, that new money, and they go out and spend it, and they get to buy assets, whether it's real estate or just going out to the supermarket and the retail sector, real economy. The wealthy get to spend that money first, and then the shop owner might say, geez, we've sold a lot of items lately, it's time to push up prices. And then the middle class buy all those items, and then over time they say, yeah, that's really popular, prices going up, supply and demand, and that's where we get this inflation that tends to be really underreported. We're told that that's 2 to 3%, but if you look at John Williams's work on shadow stats and you see, bottles of Coca-Cola getting smaller, or the number of Tim Tams in a packet of biscuits, everything around us is getting smaller, and it's just a way to hide the fact that prices are going up. But the rich, they get to that benefit first. So the people that are getting hurt the most are the small guys that get that money last as it trickles down through the economy. So they're they take a double hit there, which I believe is really unfair and something that economists don't often talk about. So despite all this, central banks told us that everything would get back to normal. They called this normalization, where they'd raise interest rates, they'd unwind their balance sheet, all that money they created to buy bonds of other banks and give the banks to lend. They were going to, unwind all those assets and put it back into the market, and everything was meant to be hunky-dory. So they only got a few weeks or a few months into this, and we saw stock markets start to crash. Bond markets, all sorts of uncertainty and fear in the markets. And it's become pretty clear that this is the global monetary heroin. And as soon as you take that away from the addict, they have withdrawal and all sorts of pain. And so central banks have already had to sort of step back in lately in terms of cutting interest rates. Now, some central banks around the world never even got to raising them. Europe is still negative. We see Australia cutting rates, and we're not even in recession. So what are they going to do if we actually enter a recession when interest rates are at or near zero around the world? So the other thing they've tried is this new form of QE. And lately we've seen it in the form of these repo markets, overnight markets where banks don't have enough reserves or liquidity on hand. So the Fed, the central bank in the US, have had to step in, and they're saying this isn't quantitative easing. This isn't the same thing. We're not buying these assets off them. This is just overnight lending or a repurchase agreement for 2 weeks later. They're saying, don't get this confused. Yes, we're going to start increasing our balance sheet and we're going to be holding more assets, but this is not QE. Back to the old trust us. And I really think that this is going the exact same path of QE, QE4 or QE forever, as some people are calling it. They're just going to have to continue to print money and buy these assets and bonds. In Japan, we're already seeing them buy stocks and ETFs and other assets just to prop up the price of everyday things, because they're so fearful about deflation and the economy slowing down and prices of things going down. And that might not make much sense to the average individual. You think, gee, some deflation and things going down in price might be good for me. But if that happens, you might lose your job because your business starts making less profits and whatnot. But that's a complicated topic for another day. The one thing I did want to talk about was those negative interest rates really hurting not only savers, but banks' profits. Because banks rely on this fractional reserve and speculating in the stock market to make their profits, when they get those low interest rates and margins are squeezed on the loans, people shop around for better home loans. They want the lowest rate. Banks aren't making as much profits, and there's banks in Europe now that are teetering dangerously close on the edge of collapse. They've tried to merge a few of these, Deutsche Bank, and they just can't get through because nobody wants all these banks with toxic assets and derivatives, all these bets that they've made using leverage. It's an absolute recipe for disaster, and that's why people want the banks broken up into, mortgage lending and business lending, the normal stuff, away from all the speculation and gambling that gets happened. Because at the moment they're pulling all the profits, but when there's a loss, it's socialised the losses. Government stepping in, or now they're talking about things like bail-ins, where your money won't be safe. If the bank goes under, they need all your deposits to shore them up, and that's already happened in places like Cyprus. So this isn't just a conspiracy theory. We're hearing capital controls in places like China, Greece, India, Zimbabwe now. In Australia, they're cracking down on those large cash payments. But this all comes back to, once there's negative interest rates, they don't want you to be able to draw out large amounts of cash. If people start drawing out cash out of banks, that starts a bank run, and banks only have fractional reserves. So if 10% of people pull money out of the bank, those banks will collapse. So governments and banks, politicians, they're all very, very fearful of these things. And it's just education is really the only barrier standing between the everyday person understanding this and taking action. So the trade wars is the other thing that's heating up lately. We see Trump on Twitter and putting tariffs on everyone, but people are starting to want to protect their local economy, and they're getting funny about immigration and jobs and working with other countries. So it really is becoming a political sphere where the next world war is being fought, in my opinion. The other thing we see with this sort of protectionism attitude, which again, there's lots of different theories about, is that local currencies are really going to suffer in this environment. So for a lot of countries, they have their own currency. But if they're not that strong of an economy and people are turning to the US dollar more, it really starts to beg the question, well, why does every little country have its own currency? And what is that really worth now that currencies aren't backed by gold anymore? So we're seeing a lot of these other countries that have a lot of US dollar debt. They borrowed a lot. Now the US dollar is going up in strength. These other local currencies are going down in strength, and they owe even more back because of how much purchasing power and how weak their currency is, that they're trying to pay back that US dollar debt that's getting more and more expensive even every time the US dollar does go up. So I think this is something that we saw back in 2008 with Occupy Wall Street, where people were protesting and becoming more aware of these issues. There's no doubt the rich are getting richer. They don't really need to worry when the collapse happens. They move off to their private locations. They've got plenty of big houses, protection. They've got plenty of assets. It doesn't matter if they lose their job. They've got that much wealth accumulated. And you think about the bonuses they pay themselves. We're hearing that CEOs are now getting paid between 2, 3, 500 times as much as the average employee. So it's just got completely out of proportion, and it doesn't really affect them when we have this big downturn. If anything, they get to scoop in and buy all these assets on the cheap when we have the next market crash. And some people like to go down the rabbit hole and say that they're deliberately doing this. So what people may begin to ask for is government handouts. We saw it in Australia back in 2008 where they gave out a lot of cash, and we saw it recently with some more tax cuts. But this is more a form of people's QE, people's money printing, and handing that out to the people. Universal basic income. Who knows where this is all going to head if people demand that the governments give money to them rather than to the banks next time around. Not only that, the average people have got a lot in unfunded liabilities that they've been promised, whether it's a retirement pension plan, Medicare, Medicaid in America, disability pensions, all these other things where governments have promised that, you're going to get paid this nice paycheck, but the number of workers to pay that and the tax receipts compared to the number of retirees, the scales are just tipping now. And I love the stat that there's more adult diapers around the world now than baby diapers because we have an aging population. And the math is impossible. There's going to be no such thing as pensions when we're older. Governments can't afford it unless they go into even more debt than what they've already promised. And, the unfunded liabilities in the US are, 100 trillion, 200 trillion. At the moment, their economy is 1 trillion. So where on earth are they going to get 100, 200 trillion to pay everyone and keep everyone happy? Well, the only way they're going to be able to do that is to print more money and debase the local currency. So this is where it's all heading for every country around the world. Now, at this time, we're hearing people speculate about modern monetary theory, where the governments don't even need those central banks anymore. They're just going to spend themselves and go into more debt and cut out the bank as the middleman. So that's another theory that's been floated around. But the fear factor here is whether or not that leads to inflation. If you start giving money to the people directly or government spending way too much, that's the worst nightmare of central bankers and governments, is if we start to get inflation and prices of things rise too fast when people aren't getting wage rises and whatnot, then how do you stop that? The only way you can do that is raise interest rates, the opposite to what we spoke about at the start, where central banks lower interest rates to give out more money and make it easy to get loans. Well, what if these people that have got massive mortgages and car debts, student debts, credit card debts, afterpay just to pay for clothes these days? It's crazy how obsessed people are with debt. Well, what happens when they raise interest rates? People are not going to be able to afford that at all. It's going to make everyone go broke and default on all their loans. So that's the nightmare scenario, that people are going to demand money, but then they may get it and it may lead to inflation. So this is why central banks, governments, banks, politicians find themselves between a rock and a hard place, and then a blockchain. I want to talk about how this ties in as well. So in this time that we're currently in, with banks really struggling, a lot of banks are dying, governments indebted, and central banks really being called to question if they know what they're doing, if their economic models even work, we're having the rise of not only digital currencies that people are becoming familiar with. A lot of currencies these days are digital. Your online banking and your payment systems, your PayPals and that you use. Money's kind of already going digital and online. But now we have digital currencies or cryptocurrencies. So once everyone understands how these work and they understand that there's a fixed supply, let's say of Bitcoin, for example, or gold, or anything that has a finite supply that governments and banks can't print more of, then all of a sudden we have a digital currency or a gold, something that's known to be scarce. We can't ever create more of it, versus all these government fiat currencies that are also digital, but they're just creating more and more of them. They're going to benefit the rich. They're printing more to pay off their debts. People can, for the first time ever, choose to park their money outside that system and choose this new system with just a click of a button with their thumb, on an app. For anyone that's, started to go down that crypto rabbit hole and they're familiar with how that all works these days. It's very easy once you understand what's going on. So even if you don't like Bitcoin because of the volatility, there's stable coins these days. Facebook's Libra, they're speculating about having a basket of all these fiat currencies around the world. Now that's a bit different again, but all these different things are just draining money and liquidity, pulling it out of the old system where people in Venezuela, Argentina, Zimbabwe, hey, maybe it comes to the US and Australia, when they can see that the government's got no option but to print a lot of money and debase the currency, they say, well, I'm not going to use that system. I'm going to park in this thing that's more scarce. And relatively, comparatively, that's why gold over time continues to go up. That's why Bitcoin has gone up like crazy, and it's starting to go up again recently. It's funny, Bitcoin went down when the central banks told us that everything was going to go back to normal. And now that central banks are having to do this again, Bitcoin has started rising again. And Bitcoin has been the best performing asset class on the planet the past 10 years. And over time, it continues to trend higher because of what is happening around the world. Central bank actions and money printing is absolute rocket fuel for Bitcoin and a lot of the other good cryptocurrencies. Now, obviously, I'm a huge fan of gold and silver. If you can store that yourself or store it somewhere else, I've done plenty of videos about how you can structure yourself safely compared to bail-ins and how you can store cryptocurrency safely if that's the option you choose. Get some cash out of the banks now while you can, if that's the option you want to take. I'm not going to tell you which one to do, but I just encourage you to educate yourself on how this all works and have an option in mind for when the day comes. You want to be one of the first people to take action, not one of the last people that finds out that the ATMs are closed like they have again, in Hong Kong recently. One by one, every country around the world is going through the exact same thing. So recently in Australia, the majority of our audience is Australian. We've had this perfect run for the economy, 30 years without a recession. But the RBA, our central bank, have come out and said that, we're thinking about negative interest rates in QE. If we have to, we're going to do anything we can to keep the economy expanding. It seems like everyone is afraid of a recession and the natural business cycle, which I just think is crazy. And they mentioned that it's going to probably push up house prices and the stock market and other assets. But hey, that's what they want. They don't want deflation. It's better than going into a recession in their minds. I just don't understand their thinking sometimes. So all this comes back to what I spoke about before. We've got this system that's all built on leverage and derivatives now. All this debt, none of it can be paid off. And as soon as anything goes the other way, and we lose the liquidity and that underlying money that's actually supporting the real economy and the actual money in the banks, as soon as bets start to go against them, they're insolvent. We're hearing about ETFs exploding last year, the volatility ETF. The bond market's in a bubble. Everyone's on the one side of the boat because governments have been buying bonds. People know it's a one-way bet. But what happens if that changes? What happens if we get a bit of inflation, everyone starts having to sell bonds and that all unwinds? It all comes back to liquidity and actual real money, and there's not enough of it in the system for all these derivatives and all the bubbles that we have currently going on. So governments have got no option but to print more money. It's just a matter of how they're going to do it. If they're going to give it to the banks and make the rich richer, if they're going to give it to the people and risk some sort of inflation. And the good scenario, the Goldilocks scenario, is that we get heaps of new businesses, heaps of startups, heaps of new jobs and innovation and wage growth, and everything works out okay. But even in that case, we'd have to be growing at 7% every year to get any chance of being able to pay off all these liabilities and debts that we've taken on. So mathematically, I actually think it is impossible even in the good scenario. And we know that the economy is not going that well. Economies around the globe are turning down. They're facing political headwinds, trade headwinds. So I just don't think there's any chance we grow and this is all rosy. So How does this end up? I think it ends up with fiat currencies losing a lot of their value, particularly in the majority of nations around the world. Maybe it's a little bit different for, say, the US, maybe the euro, maybe Australia. Maybe those top 5 to 10 currencies have a bit more strength, but a lot of these other nations that have got market caps in the trillions of dollars, people are going to move out of those, and I think they're going to choose gold, silver, Bitcoin, stable coins, whatever asset they know is going to be stable and more scarce than their local currency. So I hope you guys have enjoyed this video. For more information on anything we do, head to nuggetsnews.com.au. Otherwise, please share this with friends and family, the favorite groups that you're in online. Hit that like button, subscribe if you haven't already, share this video around, and thanks for tuning in, guys. Cheers.